You know, if you walk into a grocery store and the shelves are empty, that is bad. That means there is a shortage. But if you walk into a grocery store with a truck full of apples, and the owner looks at you and says, "I have no apples to sell, but I also refuse to buy your apples," then you know something is fundamentally broken in the brain of the economy. In a functioning market, a business is either buying or selling, usually both. That is how commerce works. That is how the wheels turn. But today, Thursday, January 22nd, 2026, the wheels of the United States precious metals market didn't just stop turning. They fell off the axle. We have received a document this morning that is arguably more terrifying than the price charts we have been analyzing all week. It isn't a government proclamation. It isn't a bank report. It is a simple trade sheet from one of the largest wholesale distributors in the United States. These are the companies that sit between the U.S. Mint and your local coin shop. They are the authorized purchasers. They are the pipelines of the physical market. And the trade sheet is a paradox. On the sell side, the column where they list what they have for sale, it says sold out. Every single line item. Eagles sold out. Maple sold out. 100 Oz bars sold out. We expected that. We know there is a shortage. We know about the Shanghai drain. But it is the buy side minus that makes no sense. On the buy side, the price they willing to pay for your metal, multiple major products are listed as no bid. Right. No bid. Let's translate that into plain English. It means that if you call this wholesaler with 1,000 ounces of silver that you want to sell, they will hang up the phone. They do not want it. How is this possible? Silver is trading at $95 an ounce. The demand from the public is up 400%. The industrial demand from Samsung and Tesla is insatiable. The price in Shanghai is over $100. By all laws of economics, these wholesalers should be begging you for your metal. They should be bidding $95, $96, $97 just to get inventory to flip to the desperate buyers. So why are they no bid not us? Why is the largest pipeline in the U.S. market refusing to buy the most valuable asset on the planet? The answer is not a lack of demand. It is a lack of capital. We are witnessing liquidity crisis in the wholesale tier. These companies are not broke in terms of assets. They technically own silver, even if they can't get it. They are broke in terms of cash. They have run out of the liquid dollars required to fund their operations. To understand this, you have to understand that a wholesaler is a volume business. They operate on razor-thin margins. They buy metal, they hedge it, and they ship it. They need massive credit lines to keep the metal moving. They borrow money to buy silver from the mint, and they pay it back when they sell to the dealer. But today, those credit lines are maxed out. The banks that lend to the wholesalers have shut off the tap. This no bid status is the financial equivalent of a heart attack. The blood, the cash, has stopped flowing to the organs. If the wholesaler cannot borrow money, they cannot buy your silver. It doesn't matter if they have a line of customers waiting around the block. If they can't write the check to you, the trade doesn't happen. This creates a frozen market. Imagine you are a local coin shop owner. You have customers screaming for silver. You call your wholesaler to order. They say, "Sorry, we have nothing." Then a customer walks into your shop and says, "I want to sell my silver." You think, "Great, I can buy this and sell it to the waiting list." But to buy it, you need cash. If you are a small shop, you might rely on selling back to the wholesaler to manage your cash flow. If the wholesaler says, "No bid price," you are stuck. You can't offload your excess inventory if you need to raise capital. The entire chain is seizing up. This is a system failure. It is what happens when the price of a commodity moves faster than the financial infrastructure can handle. The $95 price tag has broken the back of the middleman. The prompt we received puts it perfectly. This is not due to a lack of demand for silver, but due to a lack of capital at the largest wholesalers and brokerages in the country. This distinction is critical. The media might try to spin this. They might see, no billionaires, and say, "Look, nobody wants silver. The bubble has popped." That is a lie. Everyone wants silver. They just don't have the mechanism to transact it anymore. The bridge between the buyer and the seller has collapsed. We are seeing the destruction of the centralized physical market. For decades, we relied on these massive aggregators, companies like APMEX, CNT, AMARC, to facilitate the flow of metal. They were the hubs. But hubs require stability. They require functioning credit markets. And right now, the credit markets for precious metals are in a state of total dislocation. The wholesale industry tied its fate to the US dollar. They built their business models on the assumption that the dollar would always be liquid and silver would always be stable. They were wrong on both counts. Now the silver is volatile, and the dollar liquidity is drying up for anyone touching real assets. This no bid phenomenon is the first sign of targeting a hyperinflationary collapse on it within a specific sector. In a hyperinflation, goods disappear from the shelves not because nobody makes them, but because the money pricing mechanism fails. Merchants stop accepting the currency because they don't know what it will be worth tomorrow. Or in this case, they stop transacting because the cost of financing the transaction exceeds the profit. So for those watching these markets, this is a moment that demands extreme caution and a close look at the data. It is validation, because it proves the shortage is real. If there were plenty of silver, wholesalers wouldn't be maxing out their credit lines fighting for scraps. But it is a caution, because it means your liquidity is impaired. If you thought you could just sell your stack to a dealer at the click of a button, think again. The buyback button has been disabled. The dealer isn't answering the phone. You're now holding an asset that is incredibly valuable, but harder to convert into cash through traditional channels. This pushes the market toward mopping das, peer-to-peer. It pushes the market to the street. If the wholesaler won't buy your silver, your neighbor will, and he will probably pay you cash. But that transaction happens outside the system. It happens off the books. It happens without a trade sheet. The official market is closing. The gray market is opening. In the next part of this deep dive, we are going to explain how the wholesalers went broke. It seems counterintuitive, doesn't it? Silver went from $25 to $95. These guys deal in silver. They should be making record profits. They should be swimming in cash. So why are they insolvent? The answer lies in a financial strategy called hedging. It is a strategy designed to protect them. But in a vertical market, it becomes a destructive pactus. We are going to walk you through the mechanics of the short hedge. We are going to explain how a dealer can go bankrupt because the price of their inventory went up. It sounds crazy. It sounds impossible. But it is exactly what is happening. They bet on the dollar. They bet against the metal. And now the metal is calling the bluff. The destructive hedge is the trap that snapped shut on January 22nd, and it has taken the entire U.S. wholesale infrastructure down with it. To the average person, it seems impossible. You look at the price of silver hitting 95, and you think the guys selling silver must be billionaires right now. You assume that because they own warehouses full of the stuff, they are popping champagne. But they aren't. They're filing for bankruptcy protection. How can a silver dealer go broke when silver hits an all-time high? It sounds like a riddle, but the answer lies in the way the modern financial system forced these companies to operate. You have to understand that a wholesale bullion dealer is not an investor. They are not a stacker. They do not buy silver because they believe the dollar is going to collapse. They are a logistics company. Their business model is simple. Buy a bar for spot plus $100. Sell it for spot plus $2. They make their money on the spread. They don't care if silver is $10 or $100. They just want to move volume, but there is a catch. Between the time they buy the silver from the refiner and the time they sell it to the coin shop, the price might drop. If they buy 1 million ounces at $50 and the price drops to $40 before they can sell it, they lose 10 million. That would wipe out their profit margin for the entire year. So the banks, the entities that lend them the money to buy the inventory, force them to hedge. They force the dealer to enter into a destructive pact with the futures market. Here is how it works. It is called being delta neutral. When the wholesaler buys 1,000 ounces of physical silver to put on their shelf, they immediately log into the COMEX and sell, or short, 1,000 ounces of paper silver. On paper, this looks perfect. If the price of silver goes down, their physical inventory loses value, but their short position makes money. The two cancel each other out. They are protected. But what happens when the price of silver goes up, and not just up a little bit? What happens when it goes vertical? When silver goes from $25 to $95, the value of the physical silver sitting in their warehouse skyrockets. They are sitting on a gold mine. But, and this is the fatal flaw, their short position on the COMEX explodes in their face. For every dollar the physical metal gains, the paper short loses $1. Now, you might say, so what? It is a wash. They break even. In the long run, yes. But in the financial markets, you don't survive to the long run if you run out of cash in the short run. This brings us to the not margin call. The gain on the physical silver is unrealized. It is just a number on a balance sheet. The dealer cannot access that money until they actually sell the metal to a customer. But the loss on the paper, short, is realized every single day. The COMEX does not wait. Every night at the market close, the exchange calculates the loss and demands cash, buys immediate liquid cash. We call this a variation margin. So, as silver rocketed from $50 to $95, these wholesalers were getting hit with margin calls amounting to hundreds of millions of dollars. They had to wire cash to the exchange every morning just to keep their hedge open. Where does that cash come from? It comes from their operating capital. It comes from the money they use to pay their employees, to pay for shipping, and most importantly, to buy new inventory. They are asset rich, but cash poor. They are sitting on a mountain of valuable silver, but all their liquidity is being sucked out by the vampire of the futures market. This is the Mike's liquidity trap. As the price went higher, the margin calls got bigger. Eventually, they drained their bank accounts. Then, they drained their credit lines. And finally, they hit the wall. This explains the ask no bidunk status. Why can't they buy your silver? Because every available dollar they have is being sent to the CME group to pay for a short position that was supposed to protect them. They hedge themselves into insolvency, or the irony is staggering. The entire U.S. wholesale precious metals industry is being eaten alive by the very asset they sell. They tied their fate to the fiat dollar. By shorting the metal, they were effectively betting that the dollar would remain stable. They bet that silver would behave like a normal commodity. But silver is not behaving like a commodity. It is behaving like a currency that is revaluing. And when a currency revalues, anyone who is short that currency, or short the asset that measures it, gets wiped out. The wholesalers thought they were being prudent. They thought they were managing risk. But in reality, they were taking on the ultimate risk, the risk of being short a monetary metal during a currency collapse. This destructive hedge has decapitated the supply chain. Think about the scale of this. The prompt mentions that they short their entire book. We're talking about millions of ounces. If a wholesaler has 10 million ounces of silver in inventory and they are short 10 million ounces on the COMEX and the price rises 70, that is a $700 million margin call. Do you know many wholesalers who have $700 million in cash lying around? No, they rely on credit. And as we will discuss in the next part, the banks have pulled the credit. This is why the system is locked up. The metal is there, but the financial structure that moves the metal has imploded. The paper silver market didn't just hurt the price, it killed the infrastructure. By forcing physical dealers to play paper games, the banks ensure that when the real move finally happened, the distribution network would fail. This leaves the retail investor in a terrifying position. The entities you trusted to make the market, to provide liquidity to buy back your metal, are technically bankrupt. They are zombies. They are open for business, but they cannot transact. This validates the counterparty risk argument we have made for years. Even the dealer is a counterparty risk if they are playing the derivative game. The only safe position is to be the owner of the unencumbered asset. If you hold the metal and you have no debt against it, and you have no hedge against it, you're the only solvent player at the table. The wholesaler is broke. The bank is broke. The exchange is stressed, but the stacker is solvent. This destructive hedge is the mechanism of the collapse. It explains why high prices are actually bad for the bullion industry in the short term. It explains the paradox of sold out, but no bid masses. They are not refusing to buy because they don't want the silver. They are refusing to buy because the COMEX has taken all their money. The paper market is cannibalizing the physical market. In the next part of this deep dive, we are going to look at the Ortoping credit freeze. We are going to explain why the banks who lent the money to the wholesalers in the first place are suddenly pulling the rug. Why are they cutting off the credit lines right when the business is booming? It has to do with risk models and collateral haircuts. We will explain why silver at $95 is considered too risky for a bank to finance, and how this credit freeze guarantees that the no bit of contagion will spread from the wholesalers down to your local coin shop. The money has stopped moving, and when the money stops moving, the metal stops moving. The destructive hedge was the trap, the credit freeze is the lock, and the industry is inside. If the destructive hedge was the wound that started the bleeding, the credit freeze is the refusal of the doctor to treat the patient. We have explained how the wholesalers effectively bankrupted themselves by shorting their own inventory to hedge against price drops. We explained how the margin calls drained their cash reserves. But in the modern financial system, businesses rarely operate on their own cash. They operate on credit. They operate on revolving lines of funding provided by the major commercial banks. For decades, these credit lines were the oil that kept the engine of the precious metals market turning. A wholesaler would borrow $50 million from a bank to buy silver from the mint. They would sell the silver, pay back the loan, and keep the profit. It was standard industry practice. But on Thursday, January 22nd, the banks turned off the tap. We are receiving reports that the major lenders to the bullion industry are not only refusing to extend new credit, they're actively calling in existing lines. Why? Why would a bank stop lending to an industry that is seeing record demand? It comes down to risk models. To you and me, Silver going to $95 is a sign of value. To a bank risk officer, it is a sign of volatility. And banks hate volatility. When an asset creates a vertical line on a chart, the bank's risk model labels it a bubble. It labels it toxic. The bank looks at the wholesaler's inventory, which is now worth 4 times what it was a year ago, and they get nervous. They worry that if the price crashes tomorrow, the collateral backing the loan will evaporate. So they increase the haircut. A haircut is the percentage of the asset's value that the bank discounts for safety. When silver was $20 and stable, the bank might lend 90% of the value. Now that silver is $95 and volatile, the bank might only lend 50%. This creates a collateral crunch, or deals. Even though the dealer's inventory is worth more, they can borrow less hours against it. The purchasing power has been destroyed by the bank's fear. But there is a simpler mathematical reason for the freeze. It is the ATH capital constraint. Let's say a wholesaler has a fixed credit line of $100 million. That is their limit. When silver was $25 an ounce, the $100 million could finance 4 million ounces of inventory. That is a lot of metal. It kept the supply chain flowing. But today, with silver at $95, that same $100 million can only finance roughly 1 million ounces. The capacity of the wholesale industry has shrunk by 75%, just because of the price increase. The pipe has gotten smaller. This means the wholesaler can only do 1/4 of the business they used to do. They can only buy 1/4 of the metal. They can only serve 1/4 of the customers. And because they are already maxed out paying margin calls to the COMEX, they have 0-inch room to maneuver. They are bumping against their credit ceiling every single minute of the day. This is why they are no bid. It isn't that they don't want your silver. It is that they physically cannot write the check because the bank computer says, limit reached. This credit freeze is the contagion that kills the local coin shop. Think about your local dealer, the guy on Main Street. He operates on cash flow. He buys silver from the public in the morning, and he sells it to the wholesaler in the afternoon to lock in a small profit. He is a pass-through entity. But on Thursday, January 22nd, the pass-through mechanism stopped working. When the wholesaler went no bid, the local dealer lost their exit strategy. They're now holding inventory that they cannot flip. Their cash is tied up in metal. And while holding metal is great for wealth preservation, it is terrible for paying the rent, the electric bill, and the payroll. You cannot pay your employees in Silver Eagles. You need dollars. If the local dealer cannot convert their silver back into dollars because the wholesaler is insolvent, the local dealer becomes insolvent, it is a chain reaction. The current data suggests the potential for a wave of closures in the near term. We may see local shops turning off their open signs as they struggle to navigate this liquidity crunch. This is the Kerufwaning consolidation. In every financial crisis, the big eat the small. The too big to fail entities, the ones with the deepest pockets and the special relationships with the government, will survive. They will absorb the market share of the thousands of small businesses that get wiped out. We will be left with a market dominated by 3 or 4 massive corporate giants. Less competition, higher premiums, more control. This is not a conspiracy theory. It is the history of capitalism. Crisis accelerates consolidation. But before we talk about what rises from the ashes of this industry, I need to stop and have a direct conversation with you, the viewer. We are watching a collapse of trust in the financial system. But there's also a collapse of trust happening right here on this platform. We are boring currency. This channel, the one you are watching right now, we have built this community on hard work, deep research, and forensic analysis. We dig through the trade sheets, we track the vaults, we read the fine print that the mainstream media ignores. But unfortunately, we have seen a massive explosion of copycat channels. They are using our name. They are using the same avatar. They are stealing our scripts word for word and posting them on Twitter, on TikTok, and even reposting them here on YouTube. They are trying to monetize your fear without doing the work. I want to be absolutely clear. We have only one channel. It is this one. We are only on YouTube. We do not have a Twitter account under a different name. We do not sell crypto on Telegram. We do not have a WhatsApp group where we ask you for money. The other people using this avatar are not affiliated with us in any way. We do not take responsibility for the bad information or the scams they are pushing. We provide this video with a lot of research and only verified info because we respect you. So I am asking for your help. If you value this content, if you value the truth, you need to help us signal boost the original source. First, go down to the comments and type "staying with the original." Let the algorithm know you are here. Second, and this is critical, Share this video, send it to your friends, but share the link to this YouTube channel. Do not let the copycats control the narrative. If you see our video uploaded somewhere else, call it out. Report it. We are fighting a war for truth in a market full of lies. We need you on the front line with us. Now, let's return to the wipeout. The destruction of the dealer network has a secondary effect that is even more dangerous for the retail buyer. It destroys price discovery. In a healthy market, you have thousands of dealers competing for your business. This competition keeps the premium, the price over spot, in check. If one dealer charges too much, you go to the guy down the street. But if the guy down the street goes out of business, the remaining dealer has a monopoly. This connects back to the $120 street price. Why are premiums exploding? Yes, it is because of the shortage, but it is also because the competition is dying. The surviving dealers know they are the only game in town. They can charge whatever they want. They can widen the spread. They can pay you less when you sell and charge you more when you buy. The bid-ask spread, the difference between the buy price and the sell price, is about to blow out to historic levels. We could see a scenario where the dealer sells you an ounce for $130, but only offers to buy it back for $90, a $40 spread. Why? Because they have to price in the volatility. They have to price in the risk that the wholesaler might default on them. This friction kills the liquidity of silver for the average person. It makes it hard to trade. It makes it hard to use as money. And that, ironically, is bullish for the price. When an asset becomes hard to trade, people hold it tighter. They safeguard it. The velocity of silver drops to absolute zero. The silver that is currently sitting in private safes and stacker vaults is effectively off the market. It is not coming back. The local coin shop was the mechanism that recycled that silver back into the system. When Grandma sold her silverware, the coin shop bought it and sent it to the refiner. If the coin shop is closed, that silverware stays in the drawer. It never reaches the refiner. It never reaches the COMEX. It never reaches Samsung. The recycling supply is about to fall off a cliff. We know that mining supply is flat. We know that demand is up 400%. And now we know that the secondary supply, the recycling loop, is broken because the infrastructure has failed. This is the definition of an organic supply cliff. The market has driven off the edge and we haven't even hit the bottom yet. So where does this leave us? The wholesalers are maxed out. The local dealers are closing. The credit lines are frozen and the premiums are skyrocketing. The centralized market structure has failed. It was built for fair weather and we are in a hurricane. But markets abhor a vacuum. If people want to trade silver and the shops are closed, they will find another way. We are about to witness the birth of a new market. A market that is older than the COMEX, older than the dollar, older than the United States itself. We are returning to the peer-to-peer market. In the final part of this deep dive, we are going to explore the peer-to-peer future. We are going to explain what happens when the middleman is removed from the equation. We are going to look at the rise of private barter, local trade networks, and the gray market for precious metals. And we are going to analyze where the clearing price is likely to land. If the paper price is $95 and the shop price is $130, but the shop is closed, what is the real price? The real price is what your neighbor is willing to pay you. And trust me, your neighbor is about to get very, very interested in what you have in your safe. The industry is wiped out. The people are taking over. The revolution will not be televised. It will be transacted in person. We have arrived at the conclusion. If you have been with me through this forensic investigation of the wholesale collapse, you now understand the full magnitude of the event we are living through. You understand the no bid-on paradox where dealers are broke despite record demand. You understand the destructive hedge that turned rising prices into a death sentence for the industry. And you understand the credit freeze that is turning the lights out on Main Street. The infrastructure of the precious metals market has snapped. The complex web of refineries, wholesalers, banks, and shops that moved metal for 50 years. So what happens now? Does the silver market die? Does the value of your stack go to zero because you can T-sell it to a dealer? No. The market does not die. It evolves. It returns to its natural state. We are entering the era of disintermediation. That is a fancy word for cutting out the middleman. For the last few decades, we have been lazy. We relied on the system to facilitate our trades. We relied on APMEX to ship us coins. We relied on the local shop to buy them back. We paid them a premium for the convenience. But now the convenience is gone. The middleman is insolvent. And when the middleman dies, the buyer and the seller have to find each other directly. We are witnessing the birth of a massive peer-to-peer market for silver. This is not a new concept. This is how silver was traded for 5,000 years before the invention of the COMEX. You don't trade with a bank. You trade with your neighbor. You trade with your mechanic. You trade with the farmer down the road. In a peer-to-peer market, the price is not set by an algorithm in Chicago. It is set by the two people standing in the room. It is highly probable that the price in a private setting will differ from the screen price. Reports from private forums and local trading groups suggest that physical clearing prices are already trending significantly higher. Why? Because there is no bid-ask spread in a private deal. There's just the price. And right now, that price is converging on 130 million dollars. This creates a gray market. It is a market that exists outside the banking system, outside the tax reporting thresholds of the wholesalers, and outside the visibility of the regulators. It is a market of pure privacy and pure liquidity. The wholesale collapse is actually the best thing that could happen to the price of silver in the long run. Why? Because it kills the leverage. When a wholesaler buys silver, they short it on the COMEX. That suppresses the price. But when you buy silver from your neighbor, nobody shorts anything. The metal changes hands and the paper market is completely bypassed. A peer-to-peer market is a one-to-one R market. There are no derivatives. There are no rehypothecations. There's just metal and cash. This removes the paperweight that has held silver down for decades. So what is the final verdict on the price? We are looking at a permanent abyss bifurcation. There's a growing concern that the paper price on the COMEX may diverge from reality. In this scenario, it could become a secondary indicator used primarily for institutional settlement. While the physical market moves to its own beat, the minimum street price, thus the peer-to-peer price, faces significant upward pressure. If the shortage continues to deepen and trust in institutions remains low, we could see physical unencumbered metal continue to expand significantly. We could expect to see silver trading at 150 guar on the street while the screen says 100. This $50 gap is the trust premium. It is the price you pay to know that your wealth is real. So what is your strategy for this new world? Observation number 1, the importance of tavre, self-custody, is becoming clear. In a world without middlemen, individual networks may become the primary way metal moves. Observation number 2, understanding the no bidding status helps remove the panic. It isn't necessarily about the value of the metal, but the health of the counterparty. Observation number 3, this shift represents a move from institutional leverage to individual ownership. We are seeing a transition from a paper-driven market to a physical-driven one. We are watching the bus remonetization of silver in real time. It is ceasing to be a financial asset and becoming a currency again. And currencies don't need a dealer, they just need acceptance. At $95, silver is accepted. At $130, it is coveted. The system has failed, the credit lines are cut, the trade sheets are empty, but your vault is full. Those who prioritized physical possession early on are now watching this crisis from a very different perspective. In a scenario where the structure is under pressure, having an unencumbered asset is often viewed as a primary goal. Thank you for being with us on this journey. We will continue to track the collapse, the rebuilding, and the rise of the new system. Share the truth and ignore the noise. The middleman is dead. Long live the metal. Subscribe.